Most investors actually significantly underperform the broader stock market. But all of the best investors, they all utilize this same one winning strategy in their investment portfolios. And when I first heard about this strategy, I was like, wait, what? There's no way that this actually works. Like, this method is so simple and yet so counterintuitive that it was just mind-blowing that this could actually work. Hi everyone, my name's Ben, and this channel is dedicated to all things personal finance, teaching you all those things that school never prepared you for. Because let's be real guys, the education system has failed all of us. We all learned that mitochondria is the powerhouse of the cell, but nobody cares. What we actually care about is money, how we can earn more, spend less, and invest the difference so that we can engineer the type of lifestyle that we've always wanted. Each year, quantitative analysis is ran on investors to try to measure different metrics. And what they found was, during 2018, the broad S&P 500 lost about 4.4%. The broad market was going down. But the average investor actually lost about 9.4%. They lost over double the amount of money than the broad market itself. And it's not just that your typical investor loses more money during the bad years. During the good years, they also don't make near as much money as they otherwise should. A 10-year analysis from 2005 to 2015 showed that the broad market increased by about 7.3%. But the average investor only made about 4.2%. That's a difference of over 3%. So why are people losing so much money during the bad years and they're not really gaining very much money in the good years? What's going on? So in my quest to figure out what was going on with this, I stumbled upon a news article where Fidelity Brokerage Company, they had done their own independent research, and over a 10-year period, they found that their best investors were dead. Yeah, that's right. I didn't stutter. They're dead. A 10-year audit of every single Fidelity account customer from 2003 to 2013 showed that the people that had the best rates of returns were either dead or inactive. Inactive meaning they didn't make any trades. They didn't buy anything. They didn't sell anything. These are people that may have forgotten that they had even invested some money to begin with. Maybe they had a 401k at work and they left that job and did not roll it over into their new job or something like that. So for all intents and purposes, they just forgot that they had this money. So why were these dead or inactive accounts achieving the best rates of return out of everybody? That doesn't make any sense. Well, more analysis shows that most people only hold stocks for about 6 months. That's not really investing, that's just speculating on the short-term prospects of a particular company. And that speculation is fueled largely by current events or the news and media cycles. But those current events have nothing to do with the long-term prospects of that particular company. Let's take a look at legendary investor Warren Buffett. He's currently the 6th richest man in the world, with an estimated net worth of roughly about $86 billion. Now, unlike all of the other billionaires at the top of this list, he did not invent Facebook or Amazon or Google or anything like that. He didn't get rich by creating something. He got rich by actually investing his money. He knows a thing or two about investing. And according to Warren Buffett, his favorite holding period is forever. When he buys a stock, he's in it for the long haul. He's not a day trader that's trying to jump in and out of the market and time something. He says that if you're not willing to own a particular company for at least 10 years, then you should not own that stock, not even for 10 minutes. Meaning that you should buy companies that have sound fundamentals and own that company forever. Now, owning companies forever does have some benefits. You get that nice long-term capital gains tax rate, but at the same time, it seems a little bit counterintuitive, especially in today's rapidly evolving digital world. I mean, if we look back 10 years in the past, the world and the economy looked nothing like it does today. So why should you own stocks forever? But one of the biggest reasons why you should own stocks forever instead of continually buying and selling different ones is a psychological phenomenon known as recency bias. Effectively, recency bias is the idea that whatever is currently trending will continue into the future. So for example, if the stock market is rapidly climbing, it's a good set of years where everybody's making money, then everybody just assumes that the stock market will continue to go up. But that's not always the case. So when the stock market keeps climbing and the hype starts surrounding the stock market that, oh, it's a great year, everybody's making, 30% returns on their money, people start flooding the market and dumping their savings into the stock market because they have a fear of missing out. Everybody else is making money, so they want to make money as well. They just assume that since the stock market has been on a roll, that it will continue to be on a roll forever. But we all know that's not true. So what happens more often than not is people are buying in when the stock market is at its most expensive that it has ever been. Now, the stock market could continue to go up from there, but more than likely it's going to start to pull back a little bit. And as soon as things start to pull back, now the second part of the recency bias kicks in. Now they're losing money. And so when they're losing money, they just assume that they're going to lose money forever. And so they panic and they sell because nobody likes to lose money. So they bought a stock at a super high expensive price, and then as soon as it started to dip down in price, they immediately sold it at a loss. And it's this psychological warfare with our own minds that prevents us from achieving these long-term results that we're all looking for. If you can just buy a stock and hold on to it, both during the good times and during the bad times, over the course of time, you will earn significantly more money because you're not panicking and selling at the first sign of a troubled economy, and you're not buying overpriced stocks just because currently the market is on a roll. So if you want to be successful as an investor, buy good, solid companies and then just hold on to them for the long haul. Now, not only is this going to probably get you a significantly higher rate of return, but it's also a lot easier. You don't have to continually keep up with all of the news cycles and metrics. You don't have to worry about, the new Airbnb IPO that just recently hit or anything like that. Just buy good, solid companies and own them forever. If you enjoyed this video, be sure to subscribe, leave a comment down below, and as always, I'll see you all again next time. Thanks.